guest is Scott Shay, founder of Next, the Wyoming-based crypto bank that operates on a full reserve model and uses blockchain technology to enable instant payments. Scott has spent decades building banks and was also the founder and former chairman of Signature Bank, which became one of the most important banking partners to the crypto industry before its collapse in 2023. Signature also built Signet, one of the first blockchain-based payments networks used by institutional crypto firms. Now, Scott's trying to bring that vision into a new era of crypto banking. Scott, welcome to the show.
It's really a pleasure to be here, Eleanor, and Jacqueline and Gerald.
Thanks for coming on. Good to see you.
We always ask our guests this first question. What does crypto in America mean to you?
So, as a fan of your show, I can tell you that there's two ways to answer this question. I think that crypto in America should be the total revolution of historic legacy, almost 19th century banking rails to a new form of safer, secure, and non-fractional banking, frankly. I think we're at actually at a really important time when I'm actually a little bit strangely, and I'm a little bit, not strangely, but unusually, I'm actually a little bit worried about crypto in America, even with everything happening. And we can get into that.
Tell us more.
Tell us why.
Yeah. Can't just stop there.
Yeah.
So, you know my background. I've started, this is the fourth bank I founded. I founded I was a founder of Bank United Texas, of Merrick Bank, Signature Bank, which certainly became a wildly successful bank. And part of that was it let me sort of be inside the room in the banking world. I was actually vice chairman of one of the banking trade associations for a while. And I see a playbook happening, which I'm actually quite worried about. If you go back to the 1990s, right before Graham Leach Bliley, right before Glass-Steagall was essentially repealed, and I assume most of your viewers are pretty fluent in all this, so I won't unpack it all. But when the banks were sort of given a go to really consolidate, at that time, the big banks, the big six banks, had about 10-12% of market share. Over the next years, they grew dramatically. It was about 25% market share, 30% before the great financial crisis. Then it became 40% very quickly. And now the top 6 or 7 banks have 60% of the market share. And basically, they followed a playbook of embrace and extinguish. And I see the banks now, the big banks, particularly those big banks, sort of trying to be very kumbaya in, it's TradeFi, it's crypto, we're going to enhance. But the truth of the matter is that crypto, in my view, is not all that compatible with traditional finance. It's sort of like stapling paper to cardboard. Yes, you can do it, but it doesn't work that well and it's not really stable. And I think that the embrace of TradFi into crypto is sort of what the big banks did with the medium-sized banks, which is they embraced them, they offered them services. Don't forget, JP Morgan was the biggest investment bank to the mid-sized bankers and sort of was the friendly voice of anesthetizing them out of existence. I'm sorry if I'm being a little harsh, but I think it's more or less accurate.
Yeah, no, it's a great point. I'm curious about just the way clarity has gone with, you mentioned being president of a banking trade association.
Vice chairman. I was late vice chairman. I don't want to promote myself.
Yeah. Well, so how do you think the trades now are reacting to some of the kind of re-litigation and some of these issues on the stablecoin front and elsewhere, given that they are showing up and they are kind of also embracing the technology, but seem to be kind of slowing things down?
I think that, as you can see from the Clarity Act negotiations, banks think that stablecoins are really their party in terms of transactions, and ultimately they want to be they want to really make sure that stablecoins have their own little lane. And I mean, they're happy with the world's stablecoin, at least in US dollars, market capitalization being 300 billion, because that's just another mid-sized bank to them. That's not one of the multi-trillion-dollar US banks. So to the extent that they were able to make sure that there was no yield, that was a big issue. That was an issue that, by the way, I was at some conference in January and I said the banks won. I mean, they're going to win. There's no doubt. As much as so many people are invested in crypto in the United States, there is a bank in every congressional district that can call the congressman, that can have local meetings to raise money, that raises money for senators, and that power is huge. And
Yeah.
and they're totally willing to take it to use that. I mean, look, I was there too. I would have done the same thing. They're using their playbook.
Yeah. I mean, Scott, you spent decades on Wall Street, founded 3 traditional banks, and I think your analogy of cardboard being stapled together with paper or something like that is it's not something we've heard before. And everyone in this space right now is like chasing that institutional adoption or trying to, converge traditional finance with decentralized finance. So I actually think that's like a really interesting and original take, I should say, given that the state of the industry feels so differently, right? So what do you think is kind of driving that narrative right now? And like, obviously we see, billions of dollars of capital coming in. So it's not something to, like scoff at or ignore. But then from your perspective on Next Front, like, what do you see as the correct way then when it comes to crypto and banks? Or should it be crypto banks and there shouldn't be like this overlap with the traditional?
So here's what I think. So having spent decades in the banking world, I can say this for sure, that it's batch processing all the way down. So even with Signet, we created, and there was just, thankfully it was my brainchild. We created a system that was the first 24/7 tokenized system on a blockchain that had instantaneous payments. But even then, the real updating was batch. In the end, using one of the legacy, there's FIS, Fiserv, Jack Henry. The big banks even use batch processing. Some of the best really update twice a month, twice a day. It's not real time. So the transactions are being done sort of on a side ledger. I know I might be getting too deep in the weeds, but it's not really the ethos of crypto, which is through settlement. So even the biggest banks, and I'm not going to name names, they are using systems that were 1980s systems that have been improved dramatically, but they don't really fundamentally, it is like cardboard and paper. So what, having gone through now starting a new bank, I really wanted to do like, what should a crypto friendly, crypto useful bank be? And so here's the first thing I thought of, and I'm totally evangelical on this, is the whole notion of a fractional bank is incompatible with crypto. I mean, when you transfer Bitcoin, and this is what Satoshi, the pseudonymous Satoshi, was doing, which is what I loved about him. I started on this in 2013 thinking about this. And what I loved about him is you actually transfer a whole block of something to someone else immutably, irrevocably. With a dollar in a bank, in a fractional bank, you don't do that. What you're really transferring is a promise to pay. Now, that promise to pay may be insured up to $250,000, but it's not actually a dollar. I mean, it's not a block of Ethereum. It's not a block of even Dogecoin. It's a promise to pay. So the first thing you have to do is get rid of fractional banking and go to full reserve banking. In a way, what stablecoin does, except it's a little more complicated. I don't want to go there. All of your listeners, viewers, and fans know about how stablecoin works. But this is actually what we did is create a bank. But instead of lending the money, we're all five of us on this screen think we've each deposited $10 and we're looking at the same $10, but in reality, 40 of it's been lent out. Here we keep all 50 in the bank at the same time, available for everybody. So if everybody shows up day one or at any day, they can withdraw all of their money, no problem. That doesn't happen and is impossible at a fractional bank. That's totally fine in Bitcoin. It's totally fine in Ethereum. It's totally fine on any other, blockchain that really works. So that's thing one. The money's always there. It's kept in a T+0 environment with U.S. Treasuries. Thing two, and the bank is really built from technology. Our core operating system is a blockchain. We're the only bank, to my knowledge, where the core operating system is a blockchain. That means we're working on things now that we can change in a matter of months, or weeks, not years, not workarounds, not patch arounds. And if you move $1 and you move a piece of Bitcoin or a whole Bitcoin, you're actually moving the whole thing, which is super remarkable. There's no bank that does that. And that's what I'm so excited about this and being able to do it 24/7. And the other thing about crypto in America is because it's US dollars, I'm really excited to have this done outside of just the crypto world, like shipping and logistics and a whole bunch of other places.
Yeah, Scott, you made a great point on the notion about full reserve stablecoin assets, and I think that's always been one of the funniest sort of arguments to me that we've counter arguments to stablecoins that we've discussed on this show before, that you don't actually need FDIC insurance when you have all the delta, right? Like FDIC insurance is actually more of a product of the system you're describing with fractional banking than it would be if you had fully reserved assets. And one of the other things that we don't get to talk on the show a lot about, but has been sort of floating around the crypto industry since I can remember back in like 1819, is this idea of narrow banks being a really interesting vehicle for crypto assets. And if I have this right, Next is a narrow bank, right? That's your sort of the model. Could you explain a little bit about what it means? Because again, like we don't get to talk about this a lot, but it's a fascinating concept to me. What exactly is a narrow bank, and how does that work other than just being fully reserved?
So that's an excellent question. And one that before when we started out, we talked a lot about, in that we wanted to be a narrow bank because for all the reasons you just said. So that means we don't lend out a penny. We don't have CRA requirements. In other words, Community Reinvestment Act requirements. All the money just sits in a T+0 environment, so anybody can have it at any time. We're not we looked at charters, and the reason we picked the Wyoming charter, as Eleanor introduced in the beginning, was because it offered there are only about 5 states in the country, and we talked to all of them, and they weren't all crypto friendly in the time that we were applying, where you could get a narrow bank full reserve charter. So for example, we couldn't go to the OCC because you have to have CRA, you have to have FDIC, and to us, that's a bug, not a feature. And because once you're lending out money, once you're saying, well, the money's not all really there, it's close to reserve, that's an issue. And I'll be perfectly honest on this. And one of the other issues is we didn't want to take was January 2029 risk. Because on a very personal level, I saw what a hostile administration can do. And January 2029, there will be a new administration. It might be friendly to crypto, or they might say, unsafe, unsound, we don't like it. Here's our list of 2,000 line items you have to fill out to continue business. I mean, going the federal charter route where it's one person, one vote, has a great deal of risk. So having the full reserve in a state charter, but a U.S. bank, gives us that protection that we are more robust. I mean, frankly, I think we're more robust than than having a national bank charter, just because of that.
You mentioned Glass-Steagall earlier, and that, for our listeners who don't know what Glass-Steagall is, it was basically it was a law that separated traditional banks from Wall Street trading firms to stop the banks from taking risks with depositor money when they put their money in with the banks. It kind of fell apart, I think, in like 1999. But do you think that crypto and the full reserve banking model that we're seeing today are kind of bringing back some of that ethos related to Glass-Steagall, kind of the idea of keeping customer money fully protected from some of that risk?
Yeah, I'm on record. I even did a TED talk on this. I thought the repeal of Glass-Steagall was madness. I mean, why would you bring the casino aspects of the Wall Street area? I'm not saying it's a casino, but it's certainly, people are speculating. Why would you bring that into banks that are supposed to be taking deposits and keeping them safe? I never understood that. I don't think it's actually explainable other than the big banks wanted it. It was led by the few big banks. Fractional banking is seductive. It's the it's it's more profitable, but now we're in the 21st century soundly, we're a quarter of the way into it. I think it's time to move our whole financial system onto a more sounder footing so that people who want to lend money, if you want to lend money and you want to earn a higher rate of return, God bless you. Put it on a platform and lend that money. But it's not fair that you put your money in the bank thinking you can write a check on the whole amount and everybody can. And really, it's sitting lent against, the house you're in, I'm in an office building right now, or, the restaurant that I just went to, whatever. It's not really fair.
Yeah. Scott, I want to ask you too about Signature. And when you think back to the regional banking crisis and everything that happened around Signature Bank, what happened behind closed doors that you wish people could have known at the time of collapse? And why do you ultimately think, Signature did close down as a result?
Well, first of all, it didn't collapse
Okay.
and it didn't need to close down. It was, I testified publicly to the House and Senate, was wrong and unnecessary. Um,
Mm,
but the thing that stunned me, and this is actually a problem with the mainstream media, is that, a lot really wasn't behind closed doors that could have been, no one really said, well, on Thursday, Signature said it had $34 billion of liquidity.
yeah.
And that was, publicly released. And then on Friday, after Silicon Valley Bank was taken, they did run out of money, from what I can tell, as a fractional bank. And Signature Bank suffered a $18 billion run. So 34 minus 18. You don't need to go to get an MBA or a PhD to know that means it was still like $16 billion. And
Yeah.
it's also public that the bank sold $10 billion in assets over the weekend. And it's also, public at this point that bank came up with another $10 billion in collateral. So that adds up to a lot of money. And it's actually a little bit hard to understand, which is why I said I believe it was wrong and entirely unnecessary. But you just might
Yeah.
recall, and your listeners might recall, there was a time that the U.S. government didn't particularly like crypto-friendly banks. And earlier that same week, strangely, they had told Silvergate that they had to go from 100% assets or deposits in crypto to 15%. But I will say there's an excellent article that Nick Carter wrote, that people should, could read in Pirate Wires, where he got maybe 20%. He got part of the story.
Yeah, Scott, I want to ask you about the crypto rails side of that time. And I was telling Jackie and Eleanor before we hopped on that I remember as an in-house attorney at that time being on conference calls like that entire weekend, trying to figure out what was going to happen, and yeah, it was a crazy time. But um, on what you're building now, and obviously there's much more adoption of crypto rails, or at least trying to get back to that space. But we were talking about Signet earlier. I think Signet ended up being sold off to another bank, and then you mentioned Silvergate as well. There, that Sen um, sort of crypto rails platform that they had was, I think, was wound down. Um, how far back do you think that set us just on the adoption of this technology, that like, business case aside and all that, like just in terms of the infrastructure coming back to mainstream? Here we are, 3 years later, and it's like people are doing a lot of these same things. But how far back do you think that period of time really set us, like as an industry, and growing up and developing some of these rails?
That's a big question. So first of all, Signet, as I told you, or as you recall, there was a time that the government hated crypto.
Yeah.
And so um, rather than sell Signet, which would have been a multi-billion-dollar value company by itself, it closed it, shredded the system, and sent all the money back the first week after the government seized the bank. So um, the technology was really shuttered, which is on a personal level sad. Again, can't look back. I mean, probably Signature would have been a $2,000 stock today had it not been seized at the rate it was, growing. By the end of 2022, I think Signet had transferred like $1 trillion on the system. It was an enormously profitable um, system and entity. But what happened. What government did, it did. But it wasn't sold. It wasn't anything. It was shred. I think that's also public. It was part of the release. The government just didn't want to do that. I can tell you, I've had 3 people tell me that they made offers for it over time. So that they made offers for it immediately thereafter. You may know some of them, Gerald, who did, if you were involved in those. It's not for me to say publicly, but it could have been sold for a lot of money.
Yeah.
Scott, what would you say it means to be a crypto bank then in 2026? Because now we're in a more friendly administration. There's a lot of, to your point, like forward looking. What does it really look like today? And like, what is the opportunity ahead? Especially with Next in mind. Like, what do you really ultimately want it to become within that sphere?
So first of all, Jack, thank you for that question. Because on a personal level, I think this is really, really important. And I think we're bringing something new under the sun. Rather than after, what happened to Signature, just retiring and going off, I had founded 2 other banks too. And so, that was an option. Thank God. Starting June 2023, June 1st, 2023, we started working on this bank. And on a personal level, I'm determined that we're going to bring, it won't just be Next in the end as a full reserve bank. This will be the beginning of serious, solid, full reserve banking where people can trust where their money is, where they're not reliant on the whims of regulators in a fractional banking system, where people who want to lend and can get the value. I mean, the banking system right now works great for everybody except for the people who are on both sides of the transaction. What we're doing on shipping and logistics, we're creating, using programmable payments, self-service, essentially what amounts to the functionality of a letter of credit. So if I ship something, if Eleanor ships something to you and it's expecting to get paid, one of you is taking risk. Either Eleanor is taking risk that you pay her and is hoping 98% of the time you pay, or you're taking the risk that you have to go, you're going to not risk, but you're going to take the risk that either you have to prepay or you have to get a letter of credit. In most cases, people get letters of credit. That costs a lot of money. Your viewers may not be as familiar as how much letters of credit cost, but we've created a self-service platform. So both Eleanor and Jackie can go on a system, say, this is the money, these are the requirements. Check the goods came to arrive. I've shipped the goods. Check they've arrived. Checked. Gerald has checked has gone and inspected the goods, and they're actually what they're supposed to be. And then the money and the bill of lading, the certificate of origin, the veterinary certificate, the agriculture certificate, whatever, can change hands instantaneously. The bank doesn't need to be open. And we can do that, no exaggeration, for 90% less than what banks do now, with this whole elaborate ritual relating to letters of credit. It's unnecessary, but yet it's not in the bank's interest, the big bank's interest, to create a more 21st century product. We can do that. So whether you're in Detroit, Dakar, I don't know, Dublin or Dubai, it's 3 a.m. someplace, but your transaction, if you two are in different one of those places, can happen simultaneously for 10% of the cost, with real money that you don't have to worry about what happens if the bank can open the next day. You actually have possession of real US dollars. You haven't even had to go on crypto rails if you don't want to, because we're a bank, it's all USD. Plus, you can make deposits using stablecoin on our platform on the weekends, on the evenings. They can be converted by liquidity providers, and we can open the essentially our wire room 24/7. That's just like, that freaks bankers out when I talk to them about it. So we can cheapen the costs so much, make them so much more user friendly. And the truth is, why not? Why has this innovation been held back? And the truth of the matter is, it's been held back because it hasn't been in the present banking industries. And again, I saw it firsthand. I had what was it, FPV, first person view. It just wasn't in the interest of the banks. Why would it be in the interest of the banks to cut the letter of credit price 90%? It's just a pure margin grab. And so I'm like, I really think this is like, on a personal level, something I really feel that is important to bring to the world.
Scott, just to get into the news a little bit, we saw President Trump come out with an executive order aimed at making it easier for companies to access the payment system, which has been historically pretty difficult here in this country compared to other jurisdictions. But do you expect that to have any kind of impact on Next, or sort of the broader, narrow banking model that you're building? And then I have to ask you about Fed Master account as well. I know you guys applied for one. Kind of what's your timeline on that? So 2 for question there as we wrap up.
Sure. So look, I'm an advocate of people having access to the system, because I think it has to be done in a serious way, and in a careful way. I was on, actually, in September of 2020 at the Federal Reserve of New York, had a panel on this very issue. And the truth of the matter is, there was a lot of slow walking, but there was also a lot of, what should the standards be for someone to have access to the payment system? And I do think there should be a relatively high standard. I don't think, and I have a lot of fintech friends, but I don't think every fintech should have an access to the master Fed account. That is the guts of the banking system. I mean, maybe that'll change in 20 years if we're successful with full reserve banking, successful in recreating different rails. But for now, I do think that it needs to be appropriately supervised. And I think full reserve banks should have the same standing as an FDIC bank, as a tier 1 bank, because there is no risk. And we are applying, and it's not, you're obviously very close to the news and follow all of the even the sort of more hidden sites to realize, but we are applying for a Fed Master account. We believe we tick all the boxes and should have a full Fed Master account, except because we're a narrow bank, we won't have and aren't asking for and won't want a borrowing line because, again, we won't borrow from anybody. We have keep all the money. So in our model, all the money's sitting there. There is no need ever to borrow from anybody. So that's not part of what we would, we're looking for. We're just looking for, and we hope to achieve having a Fed Master account. What the timing is, that's not entirely my hands.
Well, we'll have to have you back on as that unfolds. Scott, it's been great talking to you. I think we've covered a lot of ground, and probably this is the most our audience has learned about the traditional banking system in quite a while. Before you go, we like to ask everyone, what is something else you're watching? It can be crypto, it can be non-crypto, that you think everyone else should be paying attention to.
Well, I'm going to give you an answer everybody's probably, thinking of, which is AI.
Yeah.
I think I think AI is going to be important to the payment and banking system, but I think that it is going to, and I think the thing that'll surprise people is it's going to have slower adoption in payments because I don't think any CFO is going to want to make a presentation to the board. Well, our automatic procurement system just spent $1 billion on buying something. It was absolutely convinced this product was good, but it, wasn't really there. We're going to still have human input, and no one's going to want to come home and say to their spouse, our bank accounts got, emptied out because our AI thought we just needed a lot of paper clips. So I think adoption is going to be slower. You will have AMMs. I'm watching those very closely, automated market makers. There's some history with those, with Renaissance. I'm watching that very closely. It'll be used in many ways for coding and for making processes faster, but I think actual payments, we're going to be surprised at it not having as fast adoption as people are thinking.
That
Awesome.
that's makes a lot of sense, and we'll see how it goes. Scott, thank you again for coming on, and yeah, really enjoyed it.
Yeah,
Thanks,
it's a
Scott.
pleasure, and it's really a pleasure to be on the on the Alpha Crypto podcast.
Thanks,
Thanks,
Scott.
Scott.